Hi guys, it's Dr. Ron Miller here, and today we're going to go over some basic business fundamentals with your business setup. I'm starting to notice that I'm having some questions come up about business and how to set up your business. So let's just go over an example. Okay, so when you're treating someone, or when you open up a business, this isn't the way it goes. Okay, you're not just bringing money or revenue in, or someone swipes the merchant service thing for $150, and the PT gets $150, or if you're just a solo practitioner, if you see someone for $100 and you don't make $100, that's not the way that business works. If you're doing this, you're probably scamming the system and not paying taxes, and you really don't have a business. You're just seeing patients under the table. That's not real business. I don't even know what you really call that besides scamming the IRS of taxes. But this is not the way that business works. Okay, you don't just see a patient for an hour and bill them $150 and you make $150. It doesn't work that way. So you're bringing in revenue, okay? Money is coming into the business, and whether you're the sole proprietor of it and you own the whole business, or you're an employee of the business, money isn't going to you personally. It's going to the business, and the umbrella of the business. And this is why it's important to incorporate your practice or your business, okay? And you got to work with your lawyers and your CPAs to identify what's the best way to do this. Do I do it LLC or do I do it Inc. or and then you kind of decide from there. But the purpose of incorporating this is so you are protected underneath the umbrella of the business, okay? And with this, with the LLC, most people do LLCs nowadays because of the tax benefits and the structure of way it's lined up, that your personal assets are still protected. But most people go with the LLC nowadays. So money comes into the LLC, okay? And with this, your LLC, you'll have a tax ID or an EIN number, okay? And this is when you're doing your taxes and claiming revenue, the IRS will recognize your business through your tax ID number, okay? Your NPI number is just more professional, medical. It's a number that recognizes that you're a medical practice, and whether it's individual or the company, it just recognizes that you're a medical practice, and you get that set up totally different than the IRS or through your business setup through LegalZoom or whoever you're going through. It's a total different thing. Your merchant services account is just how you process transactions, credit card, debit cards, HSA accounts, and it's linked. This is a part of the business, okay? And then you have your insurance also. Whether you get professional insurance just for yourself and your practice, or you get general insurance also if someone slips and falls. My insurance is set up that it protects the business and anyone underneath the business. So that's how I have it set up. I have general and professional insurance. So if someone comes to the building and slips and falls outside, pursuit is covered. If myself or my staff injure a patient, we have professional liability insurance, so we are covered. If someone slips and falls on the floor, we are covered with that. So there's more in depth with that: property, general, and professional liability insurance. That is, I have it set up so it's covering the whole business and any staff member. Okay, so these are different things that come along with the business. But now let's go over, if you're the sole owner and you own 100% of the business, okay? Don't think of it as it's just you. Don't think of this example. When revenue comes in, it's coming in to the business, okay? And you just happen to be the owner also. But if you're treating patients, you're the only employee, okay? So yes, for tax purposes, with the tax profits and end of year stuff, you're the owner, but you also will probably have a salary as an employee, even though you're the only business person or the only business owner or the sole proprietor or the only employee currently. Okay, so underneath the business in the LLC, you're the only PT. Just for example, let's say we charge $150 an hour. No, you don't pay yourself $150. Okay, you have to subtract out your business expenses, and you have to calculate how much money does it cost, or how much expense does it cost just to see one patient. Okay, for example, at one point, my cost per patient was like $27. So I just used the example of $30 here. It cost me $27 per patient visit because of my expenses, my rent, the light, utilities, insurance, etc., everything. You have to calculate that. So then when you subtract your expenses, then you have $120 left, okay? And then this is where you have to work with your CPA, okay? Out of the $120, how much do you want to pay yourself? And there's different things into taking a salary out versus an owner's draw. You get benefits of being an owner, and this is what you have to work with your CPA about. As being the 100% owner, what are some tax benefits that you qualify for? So you can pay yourself a certain salary. You don't have to pay yourself all this. There's an owner's draw, and then you get your pre-tax profit, and then after that, you'll get taxes taken out. You'll get income taxes taken out from the company, okay? Normally that's 20 to 40%, and then you get your net profit down here. But just because you charge someone $150 doesn't mean you pay yourself $150. You have to calculate what's the best way to do it to take advantage of the tax benefits, and then you have to ask yourself, okay, how much do I want to pay myself? Whatever you pay yourself in salary, you also have a payroll tax too. Okay, so say you want to hire your second employee, okay? So you have another PT here, but this person is a employee. They don't own anything in the actual company, okay? So say what happens whenever they bring in $150, okay? So this is an employee, and I have advanced training on what to do when you're hiring a second physiotherapist. But when that second physiotherapist is bringing $150 too, you got to take out the expenses also. And then what do you do with that $120, okay? So the expenses still get taken out of that, but this person doesn't get any part of the ownership. Now, from here, you have to calculate how much you want to pay them an hour. And that's going into a whole different side of things and stuff like that. You're not going to pay them as much as this, but you're going to pay them well. But you have to be able to make sure that they're adding in to the company and they're making the company money. You have to make sure you are making the company money. You're just taking out a smaller portion of that, okay? So maybe you pay them $60 an hour, or and then you go from there. And then you have $60 left right there, and this is up to you. And I go into further training with this about what's the best way to handle this, incentivizing, creating bonus programs for your employee to incentivize them. I'm big on incentives and incentivizing my staff, because I think that if Pursuit is making money, I believe that we should be making money also. So I incentivize everything, and that's a whole nother lecture. But you got to understand that just because you're the only PT doesn't mean that you make all of this money. And when you're second PT, this money is coming into the actual business, and you have to take out expenses, and then you decide on how much you want to pay them. And this $60 is the LLC's money. It's not your money. Okay, so that's a whole nother example there. But what happens if you want to go into business with someone and you're going to be a 50-50 owner? Okay. So this is what's interesting, is that you have to be able to, again, money is coming into the actual business, and to the LLC. And how you pay yourselves as owners is different than, you have to look at it as you both are 50-50 owners of the business, and on paper and the legality stuff and everything else is linked together, the documentation's done, you're 50-50 owners. But you as clinicians are employees, you work for the actual business too. So think of it as separate things. As you're bringing in stuff, you're going to pay yourself a salary, but then you may not take the owner's draw at all out, and you guys are left with profits at the end, and then it's up to you in the business part to decide on a plan on how you deal with profits. Okay, so the same thing happens here. If you and the business owner are both 50-50 owners, whether you're bringing in $8,000 a month and your second PT is bringing in $2,000, it doesn't matter. Your expenses are still taken out of the money regardless who's bringing in more. And then it's up to you guys to decide on how you want to pay each other, okay? So whether you're 50-50 owners, it doesn't matter. The money that this PT is bringing in still gets expenses taken out, and you still get paid on a certain salary. If this PT is bringing in less money, he still is bringing in some, expenses are still taken out of that, and then it's up to you to decide on how you want to pay your employees, because you guys are employees of the actual business, okay? So as staff PTs and bring in revenue, you have to work on your salary structure, how you're going to pay. Okay, now I'm really big on, we're in a production-based economy anymore. There's going to be no more standard fixed salaries or stuff like that. Base everything off of productivity. So if this PT is bringing in $8,000 a month, this PT is bringing in $2,000, they shouldn't get paid the same. Okay, so the company's bringing in $10,000 in a month. If this guy's bringing in $8,000, this guy's bringing in $2,000, this guy needs to be paid more for that. So that's where you have to decide on, if you are a 50-50 owner, how are you going to pay each other, okay? And then after, say you guys pay yourself, then it goes by like percentages. Say you guys are getting 50% of everything you bring in, and then you get leftover money. Okay, so you guys are still left with $60 of pre-tax profit with that. Okay, and then it's up to the business owners to decide on what is the right thing to do with the actual profit after taxes and stuff like that. So I hope this clears up a little bit of what, when you're starting out the cash-based physiotherapy practice, that this structure here is not real business. It doesn't really work that way. If you're doing it, you're probably just doing it illegally and underneath the table. That's not the way business works. When money is coming in, it's going to the actual business. Okay, and the business is getting $10,000 of monthly revenue coming in. And ownership is one thing versus the money that this PT is bringing versus this PT. So these guys are kind of employees. For example, I am still an employee of my business, and I am 100% owner of the business, okay? So yes, I take a salary out for my work, but then I am also the business owner. It's up to me and my CPA to decide on what to do with profits. Okay, so I ran through 3 different ways of going over this. What's the importance of incorporating and the different types of things, tax IDs, NPI numbers, insurance, merchant services, etc., that's associated with establishing and incorporating a business. And then 3 different ways, whether you're the sole owner and the sole practitioner, whether you hire someone versus being a 50-50 owner with someone. It's up to you guys to understand this, that you guys are working underneath the umbrella of the business. Whether you're working by yourself, it's you and another staff, or it's you and another PT as 50-50 owners. So I hope this highlights a little bit of the structure of business of when you're starting out. And it's up to you to kind of understand this stuff and make sure that you're doing it right and not just paying yourself underneath the table, because that's not really how business works. So let me know if you have any questions. I'm here to help, and thanks for tuning in.